This is a Green Trader Tax educational webinar. These tax errors will cost professional traders dearly. It's August 13th, 2016. I'm the presenter, Robert A. Green. I'm a CPA and managing member of GNM Trader Tax and CEO of Green Trader Tax. This information is educational. It's not intended to be a substitute for specific individualized tax, legal, or investment planning advice. Where specific advice is necessary or appropriate, you may wish to consult with a qualified tax advisor, CPA like myself, attorney, financial planner, or investment manager, which I am not. Errors are prevalent on tax returns for traders. That's an unfortunate thing, but it's a reality. Most active traders make serious errors on income tax returns, whether they self-prepare or engage a local accountant, even a CPA. Many miss out on trader tax benefits and overpay on their taxes. The cost ranges from $5,000 to hundreds of thousands of dollars if you're relying on the tax loss insurance of Section 475 MTM, where you can write off your losses as ordinary business losses rather than a $3,000 capital loss limitation and get an immediate big refund check. Now, in this presentation, when I say preparer, I refer to self-preparers, people who buy my guide, use our website content, run TurboTax on their own, and prepare their own tax returns. They are a preparer. And also I refer to accountants, including CPAs, who their business is preparation, only they don't know traders proficiently enough. Here's the first error: mistakenly believing you can rely on securities form 1099-B. Around February, March, the securities broker mails you a big fat statement with all your trades if it's securities. It's a simple one-page 1099-B for futures, and that's easy. My problem is with securities, because IRS wash sale rules for brokers, they may be simple, but most people do not realize that IRS rules for taxpayers are different and more complex. So don't rely on brokers for wash sale losses in most cases. A wash sale loss is tax deferred when you buy back a security position 30 days before or after making a sale at a loss. For active traders, 30 days is eternity. They buy and sell every day, several times a week. So you take a loss, you get right back into a substantial identical position. And the IRS says, you can't deduct that loss. You need to put it onto the basis of your next position and defer it. They don't want you to game the system with tax loss selling. So IRS rules for brokers are simple. Brokers have a lot of compliance, and the IRS does not want to overburden them here. So they give them simple rules. They say, listen, you broker, you just have to report identical positions on the one account, but we're going to ask the taxpayer to go the extra mile. So most people don't realize that taxpayer rules are different. Broker rules base wash sales on identical positions per account. So you trade Apple equity in the one account. You don't have to look at your spouse's account. You don't have to look at your IRA, according to the broker. No two brokers communicate wash sale information between them. So brokers have an easy time complying with IRS rules for them. But it's apples and oranges. Your rules are different. Taxpayer rules base wash sales on substantially identical positions across all accounts, including IRAs, even Roth IRAs. So you have to look at your account, your spouse's account, your joint account, your IRA, your spouse's IRA, your Roth IRA, and use software to calculate wash sales on substantially identical positions across all those accounts. That means Apple equity and Apple options and Apple options at different strike prices. You need software to calculate wash sales correctly. Here's the problem. Preparers, including CPAs, choose to play ignorant and import the 1099-B, really the profit and loss information from the broker, into the software, like TurboTax or their professional software, so then it's easy to reconcile the 8949 with the 1099-B. They know the IRS computers are going to want to do that. You can't take the easy way out. You're non-compliant with the tax law and getting into trouble. CPAs are committing malpractice. They should use trade accounting software that is compliant with taxpayer rules in Section 1091. Those are the wash sale rules. What's the big deal? You use software for everything in your life. You get the software, you run it, press a button, it's done. You can't play ignorant over that. Now, with education coming from me and others in our company, traders can avoid wash sales. That is better than ignoring the taxpayer rules and playing the audit lottery with the IRS. So if you're running the right software, you can see all these potential wash sales going into December. Really what counts is at year end with taxable accounts, you want to avoid the problem with IRAs all year long because those are permanently lost, those wash sales. But with your taxable accounts, you look at it in December and you see you have a wash sale problem in the following securities. You break the chain, you sell those, and you don't get back into those particular substantial identical positions for 30 days, so then you don't have a wash sale problem. Education's the key, not ignorance. Let's go to the next set of the deck, the next problem. Messing up Form 8949 cost basis reporting. That's where you're making the wash sale loss adjustments on Form 8949. Now, the IRS cost basis regulations make a mountain out of a molehill on Form 8949 cost basis reporting, and reconciling it with Form 89, with reconciling the 8949 with the 1099-B is a problem. I don't blame Congress for wanting to close the tax gap. Previous to these regulations, only proceeds were reported. A trader could have millions and millions of dollars of proceeds, and the IRS didn't know whether they made money or not. And some taxpayers cheated. So the IRS wanted cost basis information. The problem is, unless you do it 100% according to taxpayer rules, you're going to get apples and oranges. Plus, they had a phase-in, which made it more complicated. So they've gone the extra mile, but they've made it so much more confusing. They are going to bust a lot of tax cheats. But for the honest taxpayer, they made a mountain out of a molehill, and they need to fix it. Errors with cost basis adjustments. Now, this 8949 requires a lot of adjustments, and I'm going to show you the form next. Come back to it in a second. The IRS requires reporting each securities trade on Form 8949 with the description, Apple shares, the dates acquired and sold. They want to know if it's short-term or long-term, because if you hold it for 12 months or longer, you get that lower long-term capital gains rate, which is about half of the short-term rate at the highest brackets. And there's meaningful differences throughout the brackets. On the 10 and 15% bracket, the long-term rate is 0. Short-term capital gains are the ordinary bracket. So they want to see the description, dates, acquired and sold, proceeds, that's what you sell it for minus the commission. Cost basis, that's what you paid for the position plus the commission. Codes, like a wash sale code. Adjustments, like wash sale loss adjustments, and then the net gain or loss. Let's quickly look at the form. 8949, sales and other dispositions of capital assets. There are these boxes in Part 1, A, B, and C. They want to know what's covered on the 1099-B for basis covered, what's not, because they phased it in, and transactions that are not reported to you. Remember, whether you get a 1099-B or not, whether that 1099-B is correct or not. You are responsible for reporting your true income and loss. So you might have 6 of these forms for A, B, and C, short-term and long-term. I mean, it can get very confusing. The primary adjustment is wash sales, and that's the one that's the most trouble. Other cost basis adjustments include corporate actions like stock splits and reinvested dividends, inherited positions that you received from an estate. You want to use that step up in basis at the market value. You don't want to use the old donor's basis as you have to do for a gift position. And if you make transfers from other accounts. Now, this year in 2015, they have to cover, the 1099-B needs to cover cost basis on transfers for options and less complex fixed income instruments. Last year, 2014, they didn't have to cover the transfers. They only covered the acquisitions. We'll cover that next. Wow, those phase-in rules have made this more confusing than it should have otherwise been. But again, they were trying to give the brokers a break. They didn't want to overburden them with reporting obligations. You know, some of those smaller brokers struggled with this. You got those crazy 1099-Bs with all sorts of errors over the past few years. Many preparers mess up these cost basis adjustments. The consequences are huge. If you leave out a $10,000 cost basis, then you're overstating your profits by $10,000 and paying $3,000, $4,000 of extra taxes. That's crazy. No accountant should try to prepare this form 8949 by hand. They don't want to. They just want to attach a 1099-B. They don't understand all these nuances. They know their clients are not going to pay them to do this work manually. You can't spot wash sales manually. Why not just use the right software? We do in our firm. Check it out on our website. We have the right software that calculates wash sales according to taxpayer rules. Bingo. It generates the schedule for this 8949, and you're done. The reconciliation's a little rough with the 1099-B, but we have a footnote that explains why apples versus oranges. We lay it out for the IRS. Now, the cost basis rules are almost fully phased in. It's all about what's going to be covered on the 1099-B, what the brokers are going to have to cover. So for 2014, it was the equity options and less complex fixed income securities that you acquired in a particular brokerage account. For 2015, equity options and less complex fixed income securities transferred from another broker. In 2016, next year's taxes, there'll be complex debt instruments acquired. And in 2017, the complex debt instruments transferred. And then will be completed with the phase-in. Hopefully things will go smoother after that point. But again, until they reconcile the apples and oranges with the broker versus taxpayer rules, we will remain to have problems. And that's not fair to the honest taxpayer. So much of the tax code and what the IRS does is focused on the tax cheat at the expense of the honest taxpayer. Now, when can you skip Form 8949, which would be nice to do? There is one scenario which applies to millions of Americans, but not our active trader clients. That scenario is where a taxpayer has only one brokerage account and trades equities only with no trading in equity options, which are substantially identical positions, plus the taxpayer must not have any wash sale loss or other adjustments. So if you have no corporate actions, no splits, no reinvested dividends, no wash sales, you're single, you have one brokerage account, you don't have an IRA account, and you didn't trade equity options, you only traded equities, well, then you've got your apples and oranges are the same. You only have apples, and you can use the broker's report. Otherwise, you're going to need the tax compliance software to generate the 8949 with the proper adjustments. Why mess this up? You realize that you may have a wash sale on your broker 1099B, a big one, but maybe you had a gain in the option that's substantially identical in another account, which absorbed the wash sale and made the problem go away. Don't assume doing it correctly is going to be worse, which it may be. It also may be better, but that's no way to prepare your taxes. You need to prepare it the right way. Let's go on to the next era. Overlooking reporting of rebate income. Report these transactions as an adjustment to trading gains and losses. What is rebate income? Some traders conduct rebate trading on ECNs, electronic corporate networks, communication networks. They're these alternative trading platforms, level 2, that you see on your screen. They receive rebate income as market makers, they're day traders, scalpers, for offering liquidity. That means selling. They're putting up positions to sell. They're creating the market for the ECNs. But they also can remove liquidity, buying, in which case they're going to pay a rebate fee and a commission too. Now, these ECNs may not issue the trader a 1099B for rebate transactions, and that's a problem. They should. Preparers often overlook or hide reporting rebate transactions, which are usually income, not net charges, because they're usually offering liquidity. Now, you need to make an adjustment to trading gains and losses, because these are transactional costs. Do not report these transactions as an income item on Schedule C if you have trader tax status, or as a business expense or an investment expense. These are adjustments to trading gain and loss, in the same vein that trading commissions are. And there are traders who make errors on commissions too, preparers. Trading commissions and SEC fees or CME fees are transaction costs included in trading proceeds and cost basis reflected in trading gains and losses, whether it's on Form 8949, Form 6781 for futures, or Form 4797 for mark-to-market accounting. It's not a separately stated expense. It's in the trading gain or loss. Some preparers err in deducting commissions and other transaction costs on Schedule C. In effect, they're going to be double counting the deduction, and that's wrong. That's another error. Let's move on to the next error: mishandling trader tax status. Trader tax status constitutes business treatment, and it unlocks an assortment of meaningful tax benefits for active traders who qualify. But most preparers overlook trader tax status. They often tell me they didn't realize long-term clients had even started a trading business. They thought trading was an investing activity using Section 212's investment expense treatment and the capital gains and loss treatment. They were overlooking the fact that a trader who qualifies can have a $5,000 to $15,000 or more tax benefit due to the preference of Section 162 business expense treatment on Schedule C versus Section 212 restricted investment expense treatment on Schedule A. Many preparers don't know trader tax status at all. There's no statutory law with objective tests. They would need to dig themselves into court cases to interpret case law, which is what applies. And many preparers are misinterpreting case law. They don't know about Green's golden rules for qualification contained in Green's 2016 Trader Tax Guide. Common misconceptions that deny trader tax status include, well, I thought they had to be a full-time trader. Wrong. I figured they could not have another job in a business, that they had to be profitable. Wrong. That they had to make a living. Wrong. That they had to be a day trader. Wrong. Not meeting Green's golden rules from court cases. That's another problem. Some preparers are way too conservative and ignorant, and they miss the boat. Others are too aggressive, and they just jump on the boat without having a ticket. They figure their clients trade a lot, so they can just claim trader tax status. But the client falls short of Green's golden rules based on trader tax court cases, and they're going to have a losing position with the IRS. So look at the volume. In the Pope Court, they required 60 trades a month. That was good, 720 a year annualized, total trades. Holding period, the Endicott Court required an average holding period under 31 days. Frequency, the Holsinger Court and many other courts called for trade executions over 3 days per week. Those are the big three that the IRS can verify. If you come up way short or you have a problem with these, don't just jump on the bandwagon of trader tax status and then suffer back taxes, penalties, and interest later on with the IRS. Now, here's another error, not claiming trader tax status after the fact. So you're working with your preparer on a 2015 tax return. You're on extension. A trader can claim trader tax status business expense treatment after the fact. And the IRS does not require an election. Here's the mistake. Preparers often conflate TTS with Section 475, which is related and conditional on trader tax status, but different. So it's a mistake. A trader with trader tax status has the option to elect Section 475, but may choose not to do so. So preparers err in skipping trader tax status because they thought an election was required. So you're preparing a client's tax return, or you're self-preparing, and you realize you didn't make the 475 election, and you really wish you did because you wanted to have a big ordinary loss. And now you're stuck with a capital loss limitation and wash sale loss treatment. And that hurts. So you just walk away? No, you still can use Schedule C for your business expense treatment, which can save you a lot of money in taxes. Now let's go on to the next set of errors. You have the trader tax status. You're claiming it. You're preparing a Schedule C. A trading business Schedule C is a red flag for the IRS. And that means that there's zero tolerance for preparer errors because you're already in a red flag condition. So you don't want to beg to be audited, which so many of the traders who have lost in court this past year, Pope, Asadaragi, Nelson, Endicott, the past couple of years, they were begging for a beatdown. Huge Schedule C red flags with huge deductions, most of which seem to me to be invalid. And then huge Form 4797 ordinary losses that they may have deducted on Schedule C wrong, and they didn't even elect 475 properly. They're cheating the IRS. They didn't even qualify for trader tax status. These cases were just an abomination. And the IRS was right in their conclusions. So Schedule C is profit or loss from business. This is what a sole proprietor, an unincorporated business files, your mom and pop business, not the LLC that's a multi-member filing as a partnership or an S-Corp. A single member LLC disregarded entity can file as a sole proprietor. So notice this part 1 for income. Most other businesses, that's where they put their income, gross receipts from sales. Returns and allowances, cost of goods sold. Most businesses fill out that part 1. How do you have a business without income? And then you put your expenses in part 2, and then page 2 is your other expenses. You're going to see how it's a lot different for a trader. Here's the biggest error in those tax court cases. Reporting trading gains and losses on Schedule C is a big mistake. Some accountants err in reporting trading income and losses on Schedule C. That should trigger an automatic IRS notice or exam. It's incorrect reporting. And also, how are you going to account for wash sale losses or Section 475 MTM adjustments with that incorrect method of reporting? You can't say, well, the proceeds are like, receipts in a retail store, and the purchases are like cost of goods sold and purchases of inventory in a retail store. That may make intuitive sense to an accountant, but it's completely wrong, and it's going to be not just a red flag, but a guaranteed getting a client busted with the IRS. Preparers should list business expenses only on Schedule C. Preparers should report trading gains and losses on different tax forms. 8949 for the securities with the cost basis and the wash sales. Form 6781 for your Section 1256 contracts, your futures, where it's broken down 60-40, then goes to Schedule D, capital gains and losses. Or Form 4797 for business traders who elect Section 475. So you got this individual trader, expenses only on Schedule C, gains and losses on other forms from your trading account along with your investment account. How does the IRS figure out if you're even profitable? I'll tell you how in a minute. So there are other errors on Schedule C with the expenses. Some traders want to put in auto expense. It's a virtual business, folks. An auto doesn't make sense. Preparers overlook first-year expensing of tangible personal property, like computers, monitors, up to $2,500 per item, providing you file a Section 1.26381F safe harbor election with your tax return. You just put in that election statement. Most tax software has a box you can check for that. And that gives you the right to expense tangible property, personal property, not real property, up to $2,500. They raised it from $500 starting in 2015. So if you get an invoice with the items broken down, you can do it per item. You don't have to depreciate it and go through those depreciation schedules. Just write it right off, expense it. But you got to do it properly and put in the safe harbor election. Now, you're running a sole proprietorship, folks. It's a business. You paid someone to be a mentor. You paid someone to help you write some software for an algorithm. You have various vendors, lawyers, accountants. You really should be issuing them a 1099 miscellaneous by the due date to independent workers, unincorporated businesses. The only one you don't have to give a 1099 miscellaneous to is a C Corp, but an S Corp you do have to give it to them, providing you paid $600 or more. If you paid them $300, you don't have to issue the 1099 miscellaneous. Remember, the IRS wants everybody to report everybody else on a 1099, so no one cheats. They want those foreign banks to report stuff so people don't cheat. And there are stiff penalties for non-compliance, so get this right. Now, you can pay everyone else all you like, but it's got to be valid, but you can't pay yourself. A sole proprietor cannot pay him or herself compensation. That's important, folks, because how else are you going to get earned income to deduct health insurance and a retirement plan? You're going to need an S Corp for that. So there are also errors with capitalized costs. So this is when you buy something over the $2,500, you buy like a $5,000 computer. So you capitalize it and then preparers overlook opportunities to use Section 179 100% depreciation, which requires income. So you can look to the trading business for income. And if you don't have it there, it can look to wages from you or your spouse on a filing joint tax return. And people mess that up. Otherwise, it's carried over. Now, also preparers miss opportunities to capitalize intangible assets like software, charting software. Preparers overlook capitalizing Section 195 startup costs, where you can go back 6 months for a reasonable amount, or Section 248 organization costs, where you pay us to form your entity and have a consult with me about organizing your entity. Each of those code sections, 195 and 248, they have a $5,000 expense allowance the first year. You start your business October 1st, you go back 6 months to capitalize startup costs, you can write off $5,000. And the balance you write off over 180 months on a straight line method. So plenty of preparers kind of botch these elections and capitalizations and how the reporting is done. That's a problem. They don't fully take advantage of it. Now, remember how I said that Schedule C is a red flag? The answer is a footnote, and it's an error to not include a note because it raises a red flag with the IRS. Schedule C looks like a losing business. It's got expenses only, and an explanation is paramount to answer IRS questions and prevent a tax notice or exam, which no trader or preparer wants. Even if you win them, it's a burden. It's expensive. It's a mistake to omit a footnote. Preparers should include well-written statements with their tax returns explaining trader tax status law, how they qualify for trader tax status, the various tax treatments that they used, and elections made like Section 475, mark-to-market accounting. Now, in the footnote, preparers should ask the IRS to view their trading business as a collection of tax forms. It's not just a Schedule C. Also look at the gains on Schedule D from Form 8949 from trading accounts. So when you report your accounts, always say, Charles Schwab investment account, TradeStation trading account, or vice versa, so that they see what's trading, what's investing, and then tie it all together in a neat bow in the footnote. Otherwise, the IRS may see the Schedule C as a losing business without any revenue. Now, we have a transfer of income strategy, which we show you in Green's 2016 Trader Tax Guide, to zero out Schedule C and basically take away the red flag. That's a little more complex, so read the guide about that. Most preparers do not include footnotes. And if they do, they tell the wrong story. And that's why they don't include it. They're not sure what to write. We don't give you the footnotes in the guide. You really need to come to us on our tax compliance service for our great footnotes. And they're customized. So if you look at one of our footnotes, they're 3 pages. They explain that the trader, let me go on to explain more, so stand by. So other footnote errors. It's important to explain how trading relates to another business activity or job. If the trader lives in Pacific Standard Time, tell how they trade early in the morning before going to work. They have a 3-hour window. They trade the morning session. That's where most of the activity is. Maybe they trade the close at lunchtime. 4 o'clock close in New York is 1 o'clock lunch in Northern California. Or how they trade Forex at night. Explain how the trading business can meet all the requirements, 4 hours a day, significant resources, and not overlap too much with the trading. With the work hours. A lot of people have flexible hours now. They can do both a trading business and a job. Now, if your client left their job in May, or if you left your job in May, explain that on the tax return. Show on the wages, left in May, next to the name of the company that you work for. And then on Schedule C, show started June. So the IRS, and then explain it in the footnote. Otherwise, they may think there was overlap when there wasn't. You were a full-time trader. You just started later in the year. Now, for the occupation on page 2 of 1040, don't just put engineer. Put engineer/trader. And don't use the word investor everywhere. Use the word trader. You have to make your tax return less of a red flag. Do away with the red flag with the transfer strategy and have great footnotes. That nips it in the bud. Next set of errors. Overlooking or messing up a Section 475 election. Think of Section 475 as an insurance policy. If your trading house burns down, you can get an immediate refund check from Uncle Sam. Normally you pay a lot of money for insurance, and then you're protected. With Section 475 for a securities trader, the premium is free. It just requires a timely election statement. Now, if you elect it for 1256 contracts, futures, it's costly because then you would give up that lower 60-40 tax rate where 60% is long term. You don't want to give that up, so we recommend it for securities. Many preparers overlook Section 475 benefits. They don't even know about it. Section 475 originally was for dealers, people who are dealers on exchanges. Traders are not dealers, but Congress expanded 475 to traders in securities and or commodities in 1997. Notice the and or. You can elect it for securities only and not for 1256 contracts, so you retain the 60-40 rates on 1256. A trader qualifying for trader tax status may elect Section 475 for ordinary gain or loss treatment. Then you're going to report Section 475 trades on Form 4797 Part 2, and I'll show you that form, rather than on Form 8949 or Schedule C. Remember, that was the big error. Goes on Form 4797. The main tax benefits of Section 475 are an exemption from those onerous wash sale loss rules and from the capital loss limitation. You can deduct the whole $100,000 loss or the $1 million loss. You're not going to get stuck with the $3,000 capital loss limitation. And that ordinary business loss is going to offset income of any kind, your wages, your wife's wages. And they are part of a net operating loss NOL carryback for 2 years and or forward for 20 years against income of any kind. Very powerful benefit. But there's a decision-making gamble, and a lot of preparers err in making the decision. One of the biggest pitfalls for traders is messing up the decision-making with the Section 475 election. If you have existing capital losses from a capital loss carryover, or you have year-to-date realized capital losses, and or you have unrealized capital losses on positions you haven't sold yet, you're nursing some losses that you're hoping that positions come back, you may want to retain capital gains and loss treatment and hold off on a Section 475 election. That's because Section 475 is ordinary income, which can't absorb capital loss carryovers. Now, on the other hand, you don't want additional capital losses that are unutilized. So you meet your accountant in February next year. Well, this past year, you met in February 2016. And your accountant knew that you had some large capital loss carryovers. And he asked you how you're doing so far this year. And you were about flat. Maybe you're up a little bit. And you're about flat on your unrealized gains and losses. So you agreed in February that you were going to hold off on a 475 election. And your accountant didn't really know that much about it. He was unsure of it. So he took the easy way out. He said, let's skip it. You got a capital loss carryover. We'll skip it. Talk about it next year. You went home. Between then and April 15th, you lost a lot of money, which happened this year when the markets went down earlier this year. And you continue to think you'll skip the 475. Huge mistake. Because you should have elected 475 to lock in that loss as an ordinary business loss. You didn't need any more capital losses that you are unutilized. You could have then formed an entity for a do-over to get back to capital gains treatment. I see these errors all the time. The accountant should have been educated on all these points, and he should have told you to call him back, and he should have held your extension until April 15th, until the last possible moment. So, as you can imagine, there's so many errors on this decision making. I have a lot of them addressed in Chapter 2 of Green's 2016 Trader Tax Guide. So read that and then have a consult with me. And then even with me, in flushing out all this, there still can be a gamble to it. But at least do the best you can making the right decision. So preparers err in making a decision too early. I just told you that anecdotal story about that. Not waiting until the election deadline, which offers more hindsight. There's not a lot of hindsight that the IRS gives you. And by the way, the IRS may change these rules from mark and freeze. So when you elect it later on April 15th, it applies for April 15th. It doesn't go back, as the rules currently are now, to January. They don't want hindsight. They figure if you use hindsight in your favor, it's against their favor. It's unfortunate, folks, but that's the system we're in. Now, what preparers make a mistake on is they don't understand they can make alternative plans. You can do what's best for this year and change next year to get back for that old capital loss carryover. You can revoke 475 in a subsequent year. In the same way you make an election, you can revoke it. That's new this year. It's on our blog archive. You can set up an entity, which most traders belong in anyway, and then the entity has a do-over. The entity can elect 475 or not, and it has 75 days from inception to do it. So there's a right way to do this and a wrong way, and most people do it the wrong way. And again, you can elect 475 on securities only. Doesn't apply to your segregated investment positions. You can still have that huge unrealized capital gain in Apple stock that you've been holding for 10 years. You don't have to have mark-to-market on that if you do things right. And I'll go over that more later. And there's also missed deadlines. When people learn about 475 and they finally wake up and smell the coffee, they say, I'll take it. I want it. Give it to me. And I have to tell them, you missed the boat. It's too late. There's nothing you can do. You made a big error. I don't smile when I say that, of course. Many preparers miss the deadline for filing a Section 475 election statement. You remember the IRS doesn't want the hindsight. They don't do the election statement properly. And then there's a second step. They have to file a Form 3115 change of accounting method and a second copy to the national office. That's a complex form. You need our firm to prepare it. We don't give you that one free in the guides. That's a lot of nuances. You do any of these steps wrong, you're out of luck. It's like an insurance company. If you give them an out, they're going to take it, and so will Uncle Sam. So you don't want the IRS to disallow 475. They did it to Pope, Asadaragi, Nelson, and Endicott. Read about it on my blog. So once you get the 475 election done properly, very powerful for traders, then you got to report it properly. So don't mess up Form 4797, and don't overlook a Section 481A adjustment, which is part of a 475 election. So you're going to convert your prior year-end unrealized losses on your trading business positions, not on your investments, including wash sales, into an ordinary loss on January 1st with the 481A adjustment. The IRS may change this too, because this is another huge benefit for traders. So you finish up the year with some unrealized losses with trader tax status on business positions, and you're able to turn them into an ordinary loss on January 1st. It's been great for our clients over the past, since 1997, since they started this. But the IRS may close that door. On the 481A adjustment, they may say that's a capital loss, but right now it's ordinary. So Form 4797, let's take a look at it. Sales of business property. You're not selling, 1231 assets. You're not selling your company itself. But we are using Part 2, ordinary gain or loss. And that's where we're listing all the trades. Sort of like Form 8949, but without the cost basis reporting. But you got to list all the trades. So report each 475 transaction. The instructions say every trade, you can't do summary reporting and say details available on request. That's the old days, folks. I did it for decades. The IRS clarified that in 2005 for Schedule D, and it's the same for 4797. You need the details. The software pumps out all the details, and that you can say see attached. But you can't say on request. You got to turn in your homework, folks. Mark to market, MTM requires imputing sales on open securities positions at year end based on market prices. Most brokers won't issue a 1099B like that. They issue it for the everyman. A few have done that, and I disagree with that practice, because how do they know if their client qualified for trader tax status or not? How do they know they elected 475 on time or not? A lot of traders tell the broker they want that, but they're not entitled to it, and that's a big mess. So you should be doing these adjustments on your own in the software. If you're a day trader and you go to cash, you may not have any open positions. Again, you're not doing it on your investment positions, and you want to have separate accounts for trading with 475 versus your investment positions. Now, it's a lot better to ring fence your trading activity in an entity, a different taxpayer. Now you're going to include the 481A adjustment to convert from mark to market from cash to mark on January 1st. Now don't overlook or mess up the 481A adjustment. It can undermine everything. So again, it's the unrealized gain or loss on the prior year-end open trading business position. If you don't qualify for trader tax status in the prior year, so in 2015, you don't use a Schedule C, you're not a business trader, you start trading in 2016, you're not going to have a 481A adjustment. Now, if you have a negative 481A adjustment, it's reportable in full. That's a great benefit. If it's a positive adjustment over 50,000, it used to be 25, the IRS changed it this past year. So if it's over 50, it must be prorated over 4 years. That's again in your favor. But then many preparers overlook or err in making this adjustment. Others forget about reporting the deferral income in subsequent years. Don't do that, folks. It's just going to be a problem. Okay, let's move on to the next set of errors. Commingling Section 475 trades with investment positions. Commingling trading and investment positions confuse the IRS about qualification for trader tax status, and it messes up the use of Section 475. Those tax court cases that were lost, Sadaragi, Nelson, Endicott, they were significant investors and they used options to manage risk on their investment positions. It was all commingled. It confused the IRS. It undermined trader tax status. But it can also mess up Section 475. It's important to segregate investments from trading business positions. If you use Section 475 on your trading account and also make investments in a segregated investment account, be sure not to trade the same symbols between the two accounts, as that gives the IRS an opening to reject some 475 losses or to disallow some long-term capital gains. Section 475 requires segregation of investments in form and substance. Most preparers are unaware of these nuances and they misadvise clients. It's best to ring-fence your trading business in an entity. Here's an example. You have one big account with Fidelity as an individual. You elected 475. You want to hold on to Apple stock in your account as an investment, but you also want to hyperactively trade Apple options to manage risk, to collect income, using portfolio margining, so it needs to all be in one account. And you're planning to use 475 on Apple options, and maybe you're going to have to take a lot of losses. You're managing risk, you're not collecting income, and you want to defer capital gains on Apple equity and not pay any capital gains tax because it's deferred through year end. It's not going to work. It's going to confuse the IRS. It's not segregated in form or in substance. Just having a separate account is form. That's not enough. It's got to also be in substance. So the best way to do it is ring fencing it in the entity. This is a little more advanced, but if you're using 475 and want the tax loss insurance, you need to do it right, and consult with me about it. Next, overlooking or messing up capital loss carryovers. This is not advanced. This is the basics. It is important to enter your entire capital loss carryover on Schedule D each year. Otherwise, you could jeopardize this deferred tax asset. When you're holding a large capital loss carryover, maybe you can't use it now, but during the rest of your life, if you have a capital gain, you can use it. Not if you take it off your tax returns and don't keep carrying it forward. So Schedule D, look at this box down here. You remember, you're not entering trades anymore in Schedule D. You're using Form 8949. But what you do enter directly is this line 6, short-term capital loss carryover in full from the prior year, and there's a similar line for the long-term section. So these are some of the errors with capital loss carryovers. Some self-preparers mostly. CPAs would never make this mistake. Self-preparers mistakenly think they should only report a $3,000 capital loss carryover each year. They figure that's all they can use against other income, so that's all they'll carry over. And they'll leave out the rest. And they'll figure they'll enter that from in the next year. You just made a tragic error. Others overlook entering a capital loss carryover altogether. They forgot to enter it. They didn't realize they could even do it. Others, some of those figured, well, I'm not going to report them until I have a capital gain to use them up. These are all errors. It can become too late since the capital loss carryover year closes after 3 years. We've seen this happen a lot. It's really unfortunate. Client comes to us. I never filed a tax return. I had a 1099-B with millions of dollars of proceeds, but I lost my whole account. I know I lost $100,000 or $50,000. So how can I owe taxes? I'm just going to skip the whole thing. I don't know what to do with all of it. I'm just going to leave it out. And then years later, they have some capital gains, and they figure, let me get those capital losses back. They never filed a return, plus the IRS assessed them penalties because the IRS figured you made a lot of money. That's a whole other problem. And the IRS says, listen, buddy, if your prior year tax return doesn't show a capital loss carryover, you don't have one. That's all they care about. And then you say, well, now I want to file. And they say, tough luck. The year closed. It's 3 years late. There's nothing you can do. Can you believe that? But that's what they'll do. That's wrong. But it's the law. They want people to comply. Stay current with your tax returns properly if you want to get a benefit. The IRS does not allow a capital loss carryover unless they see it on the prior return. Now, your capital loss carryovers do not expire, but they can lapse if you don't file them. And they're unlimited. This is another big myth. Capital losses are not limited to $3,000 a year. They're unlimited against capital gains. Now, you may only deduct $3,000 against other income. That's where the limitation comes in. Now, let's say you have a year. You don't want the $3,000 limitation. You're not paying any taxes. You'd rather save it. Too bad. It's automatic. It's not optional. Overlooking the election to carry back a Section 1256 loss from futures or other 1256 contracts. These are the only losses that you can carry back. You can never carry back a securities capital loss. You can carry back losses from Form 4797 with Section 475, but as an NOL. This is a capital loss, so this is very limited as a carryback to the futures in 1256 contracts. So on your Form 6781, where you report your 1256 contracts in summary form, look at up top here in the box D. You can check it for a net Section 1256 contracts loss election. If you do that, you're not going to report it on that form, the loss. You're going to report it on an amended tax return. Now, a lot of preparers don't know about this. They don't check the box. They put in the loss, and then it ends up as a carry forward. You want to check the box and then prepare a Form 1040X amended tax return, starting 3 years back, unless you didn't have any Form 6781 gains there, then 2 years, then 1 year. And if you didn't use it all up, then it carries to the current year and forward. So you don't lose anything. You just can go back 3 years. If you don't have any Form 6781s, then you won't go back and you won't do the election. It can only offset 1256 gains. Okay, let's go to the next section. Using the wrong tax treatment on various financial instruments. You can trade the same index as an ETF, an exchange-traded fund, like the NASDAQ 100, on a securities exchange, or a broad-based index on a futures exchange, the same NASDAQ 100 as an E-mini. And the tax treatment varies. A lot of preparers don't understand all the different financial instruments and the tax treatments. They overlook it. They don't realize that some financial instruments require ordinary gain or loss treatment like the 475, or that they qualify for the lower 60/40 capital gains tax rates in Section 1256. Many preparers incorrectly think that all trading instruments use the realization method with short-term and long-term capital gains rates like exists for equities as a default method. It's wise to double-check your broker 1099 reporting too, because it may be wrong. For example, foreign futures. A few of them have received 1256 treatment in an IRS revenue ruling. Otherwise, without that ruling, they are treated as securities. Forex is a whole different world on the interbank market. Trading is ordinary gain or loss by default, but traders may elect to opt out of Section 988 into Section 1256G, the lower 60/40 rates, on major currencies only, which means that the U.S. futures exchanges list the same pairs because currencies trade as regulated futures contracts. There are special rules for Nadex binary options, swap contracts, precious metals, Bitcoin, exchange-traded notes, ETNs, and more. Find all that in Green's 2016 Trader Tax Guide. It's complex stuff, but preparers make mistakes. Many preparers don't adjust cost basis for commodities ETFs. They issue annual K1s passing through 1256 tax treatment, but if you sell the ETF, it's a security. But when you sell it, the taxpayers should make adjustments to cost basis on Form 8949 to capital gains and losses, ensuring they don't double count Schedule K1 pass-through income or loss. The broker 1099B will not make this adjustment for you. Let's look at the Schedule K1. You may get in this box 11 other income section 1256 contracts. That the IRS is going to look for you to report on your tax return. So the pass-through publicly traded partnership pass through some income to you. You got to beef up your cost basis for that, because otherwise when you sold the ETF, which a lot of traders are in and out of, they're going to double count the income. Now, if they pass through losses, then you're going to double count losses. You got to make the adjustment. The broker's not going to do it for you. Software will not do it for you. This is a manual adjustment. Let's move on to the next section. Mishandling foreign transactions. Once you venture outside the U.S., expect tax compliance requirements to increase a lot. Errors with offshore accounts held in foreign currency. It is complicated when traders open an offshore brokerage account held in a foreign currency. Counterparties, the foreign broker outside the U.S., do not issue 1099B, and accounting is a challenge. You need to separate capital gains and losses with embedded currency fluctuation. So you got into a foreign position in euros and you sold it, days later, a week later. Could it be an investment account, not necessarily even a trading account? There's some embedded currency appreciation or depreciation in that position, but that should be picked up as part of the capital gain or loss. But your cash position that you have at the foreign broker also has appreciation or depreciation. If you don't repatriate it to dollars, you may not have to pick up the transaction. It's Section 988, ordinary gain or loss. But you got to separate this accounting, and the broker's not doing it for you, and there's no software for it. And you have to use common sense. So consult with us about that. Maybe you have a U.S. broker where the account's held in dollars, giving you access to foreign markets, and they do the transfers and conversions every day. That's a lot easier. And then you do get a good 1099B. Don't overlook reporting foreign bank and financial accounts. For U.S. residents, foreign bank, brokerage, investment, and other types of accounts, including retirement and insurance in some cases, must be e-filed on FinCEN Form 114, Report a Foreign Bank and Financial Account. Just Google that, FinCEN 114. Go to the government site, not one of the sponsor sites who use the government site to e-file. It's very easy, but you're giving them the key information about the name of the foreign account, the account number, what type of account it is, the address of the bank. If your foreign bank and financial institution accounts combined are under $10,000 for the entire year, so at any point during the year, you fall under the threshold for filing and you don't have to file. If in doubt, file. You need to do the e-filing of FinCEN Form 114 by June 30th of the following year. So that date is passed now for 2015. There are large penalties for willful noncompliance and hiding accounts and cheating. You know, as a U.S. resident, you have to pay taxes on worldwide income. So whether you have an account in New Jersey or the Isle of Jersey, which is a tax haven off the coast of England, you have to report the income on both accounts, whether you get a 1099-B or not. So check the International Tax Matters resources on our website and a separate chapter in Green's 2016 Trader Tax Guide. There's lots of other international tax compliance reporting and errors. We don't have time for everything today. Errors with home office deductions. The home office is one of the biggest and best tax deductions for traders with trader tax status. So don't mess it up. You're already spending most of the money, folks, on your home. Why not convert it to a business deduction? That's why I say it's one of the best. It's on Form 8829, Expenses for Business Use of Your Home. Up top, you're figuring out the square footage and what the allocation percentage is going to be. And then in Part 2, you're putting in the expenses, applying the allocation percentage, including on depreciation, and you're coming up with the net number that you're going to move over to Schedule C or Schedule E, depending whether you have a sole proprietorship or a pass-through entity. Here are some of the errors that we find. Some self-preparers double count the real estate tax and mortgage interest deduction on Schedule A. They don't realize that the Form 8829 not only allocates the business portion to Schedule C, it allocates the remainder portion for real estate tax and mortgage to Schedule A. It does that work for you, so don't double count it. Others err in winding up with a capital loss carryover on the home office. This deduction requires income, and you need to point it to the form that has the trading gains, or you need to transfer some of the income from those forms to Schedule C to unlock the home office deduction. We have this in the guide. Unless you do that maneuvering, you're going to wind up with a carryover. If you know you have trading gains and you see a carryover, you've done something wrong. You got to do a little more work. Now, if you don't qualify for trader tax status, you're out of luck. There is no home office deduction. Section 212 doesn't allow that. Next section. Making mistakes on education expenses. Pre-business education is a significant cost for many new traders. Try to squeeze it into Section 195 startup costs for recouping some tax deductibility. Here are the errors I see with education. Many preparers incorrectly deduct education as a Section 212 investment expense on Schedule A. However, pre-business education is not deductible in Section 212 by Section 274H7. Education incurred after business commencement is a business expense. So for your pre-business education, you can't have an investment expense. So what you want to do is try to capitalize pre-business education as a Section 195 startup cost, which can be expensed $5,000 when the business commences, and the rest is amortized over 15 years, 180 months. So you can go back 6 months to capitalize a reasonable amount, like up to $15,000. So let's say that you're going to start your trading business this month, form an entity. And you took your classes for education over the past 6 months and you spend $15,000. You can capitalize the whole $15,000, write off $5,000 in the entity, and the rest over 180 months. There's a lot of iterations of how it can all work out. Like some of it can be too old, some of it's too high, some of it can be allocated with the accrual method for later on for lifetime classes. A lot of mistakes are made by preparers here. Consult with me about what you can do. It can get pretty intricate, but it's worthwhile to do so because it's a big expense for a lot of new traders. These trading schools can be expensive and very helpful. Paying self-employment tax when not owed is a huge error. You don't owe self-employment tax on unearned trading income in almost all cases. So why pay it? You know, these preparers think you're filing a Schedule C and it's got income and they think it's due. It's not. So most trading income is not earned income. Some preparers treat net trading business income as self-employment income, SEI, and they subject it to self-employment SE tax. That's incorrect unless, this is the one exemption, the trader is a full member of an options or futures exchange and trading Section 1256 contracts on that exchange using the membership. The SE tax law, Section 1402I, shows that exemption. Most traders don't have a seat, lease, or ownership on the CME or other futures exchange. So with it for 1256. This error may happen with incorrect reporting of trading gains. If you put the trading gains on Schedule C and you come to the bottom line, the software is going to pick this up, and it's a mistake. It's a costly mistake because SE tax is 15.3% of the Social Security base of $118,500 for 2016, and the Medicare portion of 2.9% is unlimited. Do not pay that high tax unless you have to. This is a related error. Deducting employee benefit plans when not allowed. Avoid back taxes, interest, and penalties by not making an excess contribution to a retirement plan. So you went ahead, you contributed to a solo 401k, only you're not entitled to. It's an excess contribution, tax penalty. You got to take the money out of the plan. And these are the AGI deduction errors. A taxpayer may contribute to a retirement plan if he or she has SEI or wages, self-employment income or wages. If you have a Schedule C consulting business, your net income is SEI, you have SE tax, and you can contribute to a solo 401k retirement plan or a SEP IRA. But trading gains are not SEI in almost all cases. So the trader is deemed to have an excessive contribution subject to tax penalties. Preparers also mistakenly take an adjusted gross income AGI deduction for self-employed health insurance premiums, but that requires SEI. If a trader wants employee benefit plan deductions, including health insurance and a retirement plan, he or she should consider an S-Corp pass-through entity, and then you'll have S-Corp wages and you'll arrange those deductions. Taking an early withdrawal from an IRA may cost you dearly. There is income tax plus a 10% excise tax, and you may have a capital loss limitation. What a double whammy. Big mistake. To take an early withdrawal from an IRA before age 59 and a half to fund a taxable trading account. It's not just that it's going to be taxable income. Maybe you're okay with that. There's a 10% excise tax penalty with very few hardship type, very few exemptions, and they're very limited. So don't plan on those. The double whammy is you might wind up with a capital loss limitation that you cannot offset against the IRA income from the distribution or the penalty. It would have been a much better idea to trade within the IRA because there you'll get the benefit of the loss. You'll just have fewer distributions in retirement. So it's a deferred benefit. Also, you can set up the entity, do a solo 401k, and have a qualified plan loan up to 50% of plan assets, no greater than $50,000. So either trade in the IRA or do the S-Corp with the 401k plan loan, rather than the early withdrawal with the penalty. And if you do the early withdrawal with the penalty, make sure you have 475, so if you have a big loss, you can offset it against the IRA income. So traders botch these withdrawals, and there's a much longer list. We don't have time for them all today. They do a rollover for 60 days only. They don't roll it over in 60 days, and then it's not a rollover. This is the last set of screens in the deck. Overlooking or messing up Obamacare taxes. That's the Affordable Care Act. Many preparers do not understand how to minimize the net investment tax for traders, the premium tax credit, or the clawback of exchange subsidies, or the individual health insurance mandate penalty. There's all these new tax forms. A lot of preparers are not that familiar with them, and there are nuances for traders, particularly with the net investment tax. Traders are going to owe that more than most other taxpayers. This is for your high income folks, the net investment tax folks. You got to have your AGI over 250K married or 200K single for it to really bite. The other forms and taxes hit you right away. So the Form 8960 is the net investment income tax. What a lot of people don't understand is that, and on this form you got the income, you got the expenses, you got the tax computation, you got the AGI threshold. It's not that hard a form. What is hard is what goes on in the calculations to get to this form. Traders may offset net investment income with trading business expenses, which first can go against SE tax. If you use them there, then you would not use them for net investment tax. But if you don't use them for SE tax, which traders don't have, you use them for net investment tax. That's the error. You can deduct the business expenses and the investment expenses. You can water down the net investment income a lot. Now, there's three different buckets: portfolio, pass-through, capital gains. The original regulations really hurt traders. We helped force the IRS to fix it. Now we ended up with a great result. Others can't take a loss from one bucket against another bucket, but your 475 losses can offset the other buckets. And we made sure that all the capital gains and losses are in the same bucket for a trader, pass-through entity or not. Your storefront accountant is going to botch this. Your local preparer is going to botch this. We won't. You won't with our education. So make sure you're not paying more net investment tax than you otherwise owe. These forms are new. The preparers don't know them. And all those other forms, I'm not going to go into them now, but make sure that you get a hardship. And it's pretty easy to qualify for a lot of these hardships. Traders may have a low income year. They may get a subsidy, but then make a lot of money and have to pay back the subsidy. Make sure you use the exchange if you can, so that you can, if you have a bad year, you can get a premium credit that you didn't initially sign up for. There's a lot to this. Read my blog posts about it. But avoid the errors. So, do you think you need help? Consider working with our CPA firm, Green, Neuschwander, and Manning, LLC. My partner, Darren Neuschwander, is co-managing member of the firm. He's head of tax compliance. My partner, Adam Manning, is co-head of tax compliance with him. We have an excellent roster of CPAs. They review all the returns in the office. Read our testimonials. They're fantastic. We help traders on tax matters. On tax compliance, which is preparation and planning. We still can do 2015, plan 2016. I do a lot of the consultations. That's what I spend most of my day doing. Consult with me about all these issues and more. I also work on the entity formations, and then our outside attorney does all the paperwork. We have CPAs who focus on the accounting, all that trade accounting, the wash sales, the mark-to-market, all these forms. And then we have all of us working on tax representation along with controversy, along with our tax attorneys. We have an incredible winning record. Don't let it go too far, folks. Get us involved. We can win for you, whether we prepared your returns or not. Or if you really botch things, hopefully we can fix it a little bit. And then we have investment management services as well for hedge funds and investment managers. Give us a call, 888-558-5257. Speak with Julie. She's fantastic. Or 203-456-1537. Email us at info@gnmtradertax.com. Do a chat session. Come to the site, Green Trader Tax. We work with clients nationwide. Worldwide, we have U.S. residents all around the world, non-resident aliens we help. From our Connecticut and Alabama offices, and we have CPAs around the country working virtually with us as well. We're a virtual firm, paperless, cloud-based, best practices, secure. Go to our About Us section, read the incredible testimonials, the media coverage, our histories, the bios. You'll be very pleased. We hope to work with you soon. So come to the website, read the blog posts, the other recordings, the tax center. Give us a call. Thanks for watching this recording, and please spread it. Share it with others that you know. We want to get the message out. Thank you.